Friends, welcome to yet another video in our series Finance and Investing Tidbits. This video gives you some kind of framework or tool so that you are able to make an assessment of a real estate investment opportunity. Now, when I talk about real estate investment here, I'm not talking about you buying a property for the purpose of your stay on an ongoing basis. Here, this real estate investment is about you buying a property with a view to rent it to someone else, and of course, benefit from the appreciation in real estate prices. Again, to make it simple, I'm not complicating this video with the tax angle and so on and so forth, because primarily an investment should be looked at purely from a return perspective without bringing in the tax benefit. In fact, globally, what has happened is on the back of so-called tax reductions and tax benefits, prices of real estate have gone through the roof worldwide. And then, of course, we are in that trap where, having the property prices having already gone to a very high level, they of course create a risk in terms of either the prices remaining sticky for a long time, or in some cases they even declining. So tax benefit should never be our primary reason for making any investment, leave alone real estate investment. So therefore, in this particular video, I'm not bringing in the tax reduction angle at all, because again, that will vary from person to person. Again, we also know that the interest related deduction has now been restricted exactly for this reason. Otherwise, people just get into putting money into physical assets like property, even if they may not really have a need, and in the process, they expose themselves to a price risk, which we have experienced over last 7-8 years. A lot of people who have bought property have not really seen much appreciation. On the other hand, it has resulted into a lot of society outgoings and other expenses, maintenance and so on. And also in many parts of our country, the rentals have crashed. So it is very important that we actually put our thoughts together and at least put a model together about the investment that we are envisaging. Exactly to help you in the process, I am going to make a downloadable Excel file available to you. So what you can also do is pause this video now, download that file from the description box, and depending on your own comfort and convenience, look at that Excel file and look at this video. Though what I'm going to do is, anyway, I have brought the relevant sections of that Excel file into this video itself, so that you are able to even get a good sense of what we are trying to look at and how we are going to unfold this story in terms of checking whether it's really worthwhile going ahead with an investment. Plus, in the cells which are blue in color, you can change those input values to see the impact, and you can play around with those numbers. Of course, I'm going to give you a flavor of all that as we go along. So welcome to this video after such a long introduction. Okay, so now let's talk about some data here, some estimations that we have done. Let's say we are investing in a house with a 10-year view. Well, we never generally invest in a house with a limited view. We always invest in a house with a perpetual view. Not only we are going to recover rent from that property for years and years, but probably we'll also leave this property to the next generation. That's the typical view. But when you analyze whether any real estate investment is a good investment or not, you also need to kind of put a framework of time around it. So I have assumed a 10-year view, and you are going to invest 100 lakhs or a crore of rupees, and let's say rental in the first year is 1.80 lakhs. Now these numbers you can change, right? You can play around with these numbers and see the impact. Let us say that there is a 6% likely growth in the rental. let's assume that you will be able to renegotiate a higher rental with every passing year. That does not necessarily happen, but I'm just saying that could still be possible. Of course, you can change the rental if you think based on the realistic set of numbers. It could be 2.40 lakhs or 20,000 rupees a month. Feel free to change those numbers. But the point is, I'm just trying to explain to you the model that I have put together, right? And of course, you can change any number that you feel like, depending on your assessment of the situation in the context of the investment that you are looking at. Let us say that society outgoings are 3,000 rupees a month, which is 0.36 lakhs per year. There is likely increase of 5% year after year. And let's assume that after 10 years, you will be able to sell this property at about 150 lakhs. And let's also assume that the occupancy rate is likely to be 90%. What do I mean by that? Say, for example, you rent out a property to somebody, say for 2 years. After 2 years, the person is going to vacate it and gives you 1 month's notice as per the contract, as per the agreement. But you are not able to find another party. Then there could be some time lag between the earlier party vacating the property and the new party kind of moving in. Sometimes the new party which moves in expects you to do a certain touch up in the flat, give a coat of paint. All those expectations also are there, and plus there is a certain time lag which happens. So I have assumed here a 90% occupancy rate. Maximum it can be is 100%, but that's not realistic. So you can assume 90%, 80%, whatever you think is appropriate given the circumstances. So once you feed this data, you have to also look at another set of data. And that set of data is, how are you going to fund this house? So here I have assumed that 20% funding is going to come out of your savings, which we can call as your equity in that house. And 80% is loan or debt. Now, let us say that the cost of equity is 12%. Now, what is the basis of this? Say, for example, when you're going to take away your money from some other end use and you're going to put it in the house, you have to look at what else you could do with that money. Are you going to invest in stock market in India? Well, then the opportunity that you have to do something else with that money could be between 13 to 16%. Or are you going to take a portfolio view and say that 70% of that 20% I would have put in, say, equity, the balance I would have put into some bond fund. Whatever that investment plan that you may have had, whatever would have been the return there becomes your cost of equity. Because by not investing money where you would have otherwise invested, which is shares or a Nifty index fund or a part of it in a bond fund, whatever would have been the weighted average return out of that portfolio is what you'll have to put in as your cost here. Because by not investing there and moving that money for buying this property, in a way it becomes your opportunity cost, and that should be captured here. I have assumed here to be 12%. Let us say that you are able to take a loan for 80% of the property price, which is say 100 lakhs. Let us say that you are able to take a loan for 80%, which is 80 lakhs, and the cost of that is 7%. Now, if you take a weighted average of this, that is 20% into 12% plus 80% into 7%, and take a sum total, you will find that the weighted average cost of funds for you is 8%. Now, this 8% becomes our benchmark to evaluate whether investment in this property is really worthwhile or not. Because the investment has to generate a return of at least 8%, which is the weighted average cost of funds, conceding that you are able to take a loan at a very attractive rate of interest of 7%. But that's 80% of the property price. So 20% is going to come from your savings, which you are otherwise able to deploy at 12% somewhere else. So that collectively gives us the weighted average cost of funds, which is 8%. Remember this 8% number as we progress. Of course, you can play around in the Excel file and change the weight, change the cost depending on whatever is the realistic scenario for you. I have fed in some data, which is what I have captured here in this video. Also, the same data you will find in the file. Let's move on. Now, how are the cash flows of this whole investment going to look like? Time zero, which is today. So here again, you will see in the first column, the time map, which is from 0 to 10 years, which is what our investment horizon is. 0 is today, 10 is 10 years from now, 1 is 1 year from now, 2 is 2 years from now. And to make it simple, we are assuming that the investment happens today, but the first rental we are going to get at the end of first year. In reality, that's not going to happen. You're going to get it right from month 1. Similarly, society outgoings also you'll be paying right from month 1. But to make it very simple, because there's no point in trying to make the model very complex and trying to make it very accurate. The purpose of a model like this is that at least we put our diligence in place and put it on a piece of paper or in an Excel file before we commit to buying a property with a view to rent it out, right? Or it could be a residential property, it could be a commercial property, whatever that may be. Same framework applies. So what you find is that there is a certain rental which we have put in here. The society outgoings have also been put in here. And therefore, in year 1, the cash flow is going to be the net of these two, 1.62 minus 0.36, so 1.26. And then the rental will also keep on growing, the society outgoings will also keep on growing, and therefore we can arrive at the net cash flow for each year. For example, for year 2, 1.72 minus 0.38 gives us 1.34, and so on. In the last year, which is the 10th year, you'll have rental, you'll have outgoings. The outgoings would have also grown over a period, rentals would have also grown, but you would be able to also realize the property price by selling the property for, let's say, 150 lakhs. So we can arrive at the total cash flows of this investment. Time zero, it is minus 100, and then there are some pluses, and then finally a very large plus when you're going to sell the property. Let us see how to analyze this. As we have already seen those different cash flows, I have brought them forward here in this table also. So from year 0 to year 10, in the second column, we are able to see the total cash flows from time to time. So minus 100 lakhs to finally 152.18 lakhs, and smaller numbers during this period. Now, the way financial decisions are taken is that all these cash flows which happen at different periods of time have to be converted into a common time frame, which is today, because we're going to take the decision today. Today means time zero. So what has to be done is that every future cash flow has to be converted to its present value. Of course, you can see my videos on time value separately, but very quick revision of that, the way it has to be calculated is that we have to arrive at this factor by dividing 1 by 1 plus r raised to n, r being the rate of interest, or our weighted average cost, which is what you remember we had talked about as 8%, right? So what you can do is examine the Excel file for the formula, but I'm just telling you that the formula is based on the logic 1 divided by 1 plus r raised to n, r being the rate of return or weighted average cost in this particular case, and n being the period. So if it is year 1, then n will be 1. If it is year 10, n will be 10. So what we need to do is convert the cash flow to its present value using this present value factor. This present value factor is arrived at using the logic that we have learned in the school, which is that of compounding, or what is called in Hindi as Chakravruddhi, or in Marathi as Chakravard, Vyaj, which is cyclical way of calculating interest on interest, right? That is true when we convert today's value to a future value. But here we are not doing that. Here we are converting future value into its present value. Those of you who are interested in understanding this time value in greater detail, I will also share with you in the description box a link to my video on how to calculate EMI. That's where I have explained the concept of time value in great detail and the concept of present value also. So please have a look at that. So what we are doing is the cash flow which is happening from year to year is being converted into its equivalent present value. Now the cash flow which is happening today, which is minus 100 lakhs, which is the investment that we are doing in the property, is of present value 100 lakhs only because the cash flow is also happening today and we are also arriving at the values of today. But as you will see, all the future cash flows, their present value factor is less than 1 and it keeps on getting reduced. In other words, if we are going to get say 1 rupee at the end of 10 years, it is like getting 1 rupee multiplied by 0.4632 today, which is like getting 46 paise today. So if somebody gives you an option of walking away with 46 paise today or 1 rupee after 10 years at the rate of return that we are expecting, which is 8%, both are actually the same, right? Whether you walk away with 46 paise today or you walk away with 1 rupee after 10 years, if you multiply that 1 rupee with that factor of 0.46, anyway you would get the equivalent present value of 0.46 only. But I'm not burdening you with all that logic. That logic you can surely understand through other video. So what we are trying to do here is, we are now arriving at the present value, which is simply a multiplication of the cash flow number with the present value factor. So minus 100 into 1 becomes minus 100. 1.26 multiplied by 0.9259 becomes 1.17. 1.34 into 0.8573 becomes 1.15, and so on and so forth. Now, what is our real test? Our real test is whether the present value of the cash inflows, which is the rental minus the society outgoings, plus the final sale price of that property in its today's value. So see here, we are going to sell the property for approximately 150 lakhs. But what is its today's value? Today's value is barely 70 lakhs. Today's value. So if we take a total of the present value or today's value from minus 100 to 70.49, we get actually a negative 19.66 number. In other words, if our estimations are what we have put in there and our weighted average cost of funds is 8%, this particular investment is not even generating sufficient return to make the present value a positive number. When can we say that the present value is positive? When the future cash flows, which is the rent that we are going to get and the sale value of the property that we are going to get at the end of 10 years, their collective present value is more than the investment value. Only then we can say that the net present value is positive. Whereas in this case, the net present value is coming to be negative because the present value of our investment is minus 100 lakhs. But sum total of 1.17 to 70.49, if you take a sum total, you will find that it is barely 80.34 lakhs. So we are getting back in today's value 80.34 lakhs and we are spending 100 lakhs today. So this is not going to be a very good thing. So therefore the net present value is minus 19.66. When it is minus, net present value is minus, it tells us that it is not a good investment. It doesn't mean it's a write-off. You need to revisit your estimations and see whether you can buy another property for, for similar rental opportunity, which can cost you only 80 lakhs rather than 100 lakhs or 75 lakhs rather than 100 lakhs. Then you could have an attractive opportunity. So that is how we need to analyze it. So once you have downloaded the Excel file, you can look at, the reality of your own situation and take a view whether that particular investment is good or not. Otherwise, what happens is we just take decisions based on a hunch. Lastly, there is also a tool or a technique called as IRR, internal rate of return, about which again I have created various videos. So you can explore them. And Excel helps us to directly calculate the IRR using the IRR formula which is already available in Excel. What we can simply do is, when we plot the various cash flows right from -100, as we have already seen, to various cash flows year by year, and the cash flow at the end of the 10 years including the sale value, and if you use the IRR formula available in Excel, you will find that the IRR is coming to only 5.52%. IRR is the internal rate of return, or the return that this deal is generating for us. If you were to invest 100 lakhs in the property and then have various cash flows and sell it at the end of 10 years, the return that is being generated by this transaction is only 5.52, whereas our cost of funds are 8%. In other words, the IRR is not even going to meet the cost of funds, and there is a shortfall of 2.48%. If this is the case, this IRR tool also tells us that it is not worthwhile going ahead with this investment. Now, if you find that the rentals are going to be much higher, let's say 25,000-30,000 per month, you can change those numbers and see what the situation is, whether the NPV is positive and whether the IRR is more than the cost of funds. Only then it's worthwhile going ahead with this investment. Otherwise, it's going to burn value for us, which we cannot afford. So this is how you can simply analyze this decision, and I hope this kind of a video is useful to you. But if you have not already downloaded the Excel file, please download from the link in the description box. And as I promised, I am also going to share with you some other links there, like the concept of time value and EMI. Do explore those videos as well. And if you have liked it, feel free to share it with your friends so that they also benefit. Thank you.